Hello, everyone, and welcome to the third edition of the State and Local Tax Webinar Series presented by Frederickson and Byron in partnership with the Society of Minnesota CPAs. My name is Kyle Brame, and I'm a state and local tax attorney with Frederickson and Byron. Together with my co-presenter and colleague, Masha Yabzelman, it is my pleasure to welcome all of you here today. As I've mentioned in past weeks, in addition to the initial 4 webinars we currently have scheduled, we're looking to expand this series into the future. As such, I would like to encourage all of you to please use the evaluation, which is available following this session, to suggest additional topics you would like to have covered. In addition to next Thursday's session, which will cover some interesting issues coming up on audit and some strategies to defend against them, we are working through which topic might make sense to present next. On a related note, after next Thursday's session, we will likely be moving forward on a once per month basis with sessions taking place from 2 o'clock to 3 o'clock Central Time on the first Thursday of each month. Before we begin, a couple quick technical issues to discuss. First, this webinar is taking place using Zoom video conferencing technology. All of your audio is muted throughout the session, but we encourage you to use the chat button at the bottom of your screen to submit any questions you might have. Also, the slides from today's presentation are available for download from the Frederickson and Minnesota CPA registration sites. This session is eligible for CPE credit, and CLE accreditation is pending in both Minnesota and Iowa. In order to earn CPE credit, you must respond to the polling questions taking place throughout this session. The reconciliation of those responses and submission for individual CPE credits will be completed during the beginning of next week. At this time, we will begin our first polling question. And our polling question asks, how active is your organization in the tax controversy space? We figured since it's our topic today, let's see where we're at. We'll keep this open for a while and then give you a warning before closing it. Okay, and we can close our poll and show the results. All right, well, it looks like, as everyone can see from our poll results today, we have a mixed bag in terms of likelihood of moving forward in controversy, but the biggest group obviously taking the approach of if it makes sense, we'll go forward with it. Before we, this session, as I mentioned, is eligible for CPE. Appreciate everybody responding there. I would like to, again, in speaking about the CPE accreditation, take a moment to thank the Society of Minnesota CPAs for their partnership in offering this webinar series. And a quick thank you to Masha, a shareholder at Frederickson and the chair of our tax disputes practice, for joining me here today. Finally, I would like to thank all of you, our attendees, for taking the time out of your day to join us. With that, let's take a moment to go through our agenda for today. We have a lot of content to go through in a 60-minute period. I think we could have probably filled a half a day with what we have in our slide deck. So understand that while there's a lot of content in the slide deck, we're going to be going through things at a high level and really appreciate your feedback and hearing from you which areas you'd like to hear about most. We're going to start out just talking through the different phases of controversy, from audit all the way through different phases of the appeals process. Moving then into speaking about refund claims, audit examinations, ultimately getting to the appeals process, including both the administrative level as well as litigation. And with that, we will move on to our second polling question. Our second polling question asks, which area would you like to hear more fully explored in a future session? Refund claims, audit examinations, administrative appeals, or litigation? We will keep that open for 20, 25 seconds and then close it down. All right. So it looks like we have a future topic to discuss. With that, I will hand things over to Masha.
All right, thanks, Kyle. So I want to echo what Kyle said. Thank you for joining us here on this webinar today, and we'll try to make this as fun as possible. I think, as some of you know who have seen Kyle or me present before, that we are very engaging with our audience, and so it's a little hard to be engaging when we're doing this from our houses, but we'll do the best we can and try to keep things as entertaining as possible. So the first topic that we're going to talk about is, what is the process and the phase from audit all the way through the end of appeals? What does that mean? And so here on this slide, we've listed sort of the variety of venues before which you may have a tax dispute: audit level, administrative appeal, various tax tribunals, and various courts. And so I think the purpose of this section is to just really set the framework for the process that a tax controversy matter would go through. And the most important takeaway, I would say, is that that process can vary significantly from state to state. There'll be some similarities, but it is really, really important to be familiar and consult with local experts in each state so that you can best understand what are the available paths and what is the best path in any given case, given the issues, given the friendliness of the tribunal that you'll be before, whether it's a tax tribunal or the administrative appeals agency, or court, and what are some of the traps that are sort of difficult, if not impossible, to just ascertain from reading. And so that's kind of the big takeaway here, and we'll get into more detail about some of the different strategies at each level and how you pick one venue over another toward the end, but this is just to set the framework. And so the next slide just gives an example of the variety of options that's available. Just let's start with Minnesota. And so this slide shows the options for a refund claim path. So you file a refund claim, it might get audited. If it's denied, you might go to an administrative appeal, or you may skip that. And then with a refund claim, if you either get it denied or have no action on it, you can go either to district court or the Minnesota tax court. And so with a refund claim, there's a wide variety of options of what to do if you're either getting no response on it or a denial. So in Minnesota, for example, if a refund claim is pending for more than 6 months before the Department of Revenue, after you file it, you can right away go to tax court or district court. You don't have to wait for a denial. It's sort of called an optional deemed denial. It's not mandatory, and we'll get into what that means, but it's your choice. So you can either wait for action or you can push the refund claim forward. And it's the same thing at administrative appeals in Minnesota. If you have an administrative appeal that's pending for more than 6 months, you can either go to district court or tax court right away. If a refund claim is denied, you can either file an administrative appeal or go to the Minnesota tax court within a certain period of time, or you have a longer period of time to go to the district court. The critical difference between the two paths ultimately is that if you go to district court, you have to go to the Court of Appeals before trying to get before the Minnesota Supreme Court, which is discretionary, versus tax court gets a shortcut. You automatically get to go to the Minnesota Supreme Court, and they have to review it, so they don't have to grant you oral argument. So on the next slide, it shows the assessment path in Minnesota, which is very similar. The only way, though, to get to district court instead of the Minnesota tax court is you have to pay on the assessment and then file a refund claim and sort of start the process over like we did on the last slide. And then the next slide shows a sample path in Wisconsin, which is a little bit different. So in Wisconsin, you have to go through the administrative appeals process following an assessment. And then you get to go to the Wisconsin Tax Appeals Commission, and that's where the evidentiary hearing is. That's where the record is made. But from there, instead of going to an appellate court, you get to start at the bottom of the court system. So you start with the circuit court. And normally a circuit court or a district court would have the evidentiary hearing. But in this case, this kind of generalist trial judge sits in more of an appellate capacity, which means they review the records that was before the Tax Appeals Commission and make a decision on that. And so there's varying levels of deference that will occur at that level. So it's a much different process. And so I think that's the takeaway, is that you really need to know the process in the state where you're thinking about filing an appeal or going through a controversy process. So with that, I'll turn it over to Kyle for refund claim strategies.
Yeah, thanks, Masha. So I think, we wanted to start with the process piece just to get kind of a level framework on how, generally speaking, the controversy process works. And obviously, as Masha mentioned, very different depending on the state you're in and depending on kind of the level of review you're in. As we move forward, we're going to first kind of tackle refund claims and then move into the audit examination side. So on the refund claims, we're going to start by just discussing some procedural issues. First and foremost, as we think about refund claims, states vary on one very important thing, and that is whether a purchaser is allowed to file claims on their own or if they have to go through vendors. In the states that require going through a vendor, which we would refer to as vendor claim states, there's a very specific, from a procedural perspective, issue just to consider here, because it is a trap. When it comes to vendor claims, states will have different rules around what is required of the vendor in order to submit a refund claim and ultimately get, hopefully, that tax back to their purchasers. And that really comes down to what the timing requirement is around refunding those amounts that are refunded to the vendor to the purchaser, who ultimately paid the tax, just not to the department. Some states will have strict requirements that has to actually be provided, that refund has to be provided from a vendor to a purchaser prior to the refund claim even being filed, which, when you think about it from a vendor perspective, that's not a great proposition, right? You're sitting in a position where now you're being asked to cut a check to your customer for amounts that you hope the state is going to refund you. And if not, then you are set up in a difficult position from a customer-facing perspective. The other group, a number of states will have strict requirements that vendors cut a check and refund those amounts to their customers within a specified time frame after getting the refund from the state. Now, that's better than the first group, but it's still not without risk, because oftentimes departments can actually come in and reassess tax at a later point in time. So again, leading to a very difficult vendor-customer relationship moment. On the other side, we have these purchaser claims, and states vary fairly wildly in terms of when they'll permit purchaser claims. Some just don't permit them at all, and some will permit them across the board. However, there are the others that have a litany of different requirements. Some will say a purchaser can only file a refund claim if the vendor has waived or assigned their right, or if they can demonstrate that the vendor refused to respond or refused to file the claim. Other states will have different limitations on refund claims, and the one that, being here in Minnesota comes to mind is Minnesota's rule that you can only file 2 refund claims per year. So I think the message here, again, is that these things vary wildly by state, and you just got to know your state and know the rules that are applicable within that state. Some just different, very specific circumstances to address here, and the first one is around bad debts. We're not going to dig into bad debts too deeply, because that is a session in and of itself with a lot of interesting case law throughout the country. But the essence of the bad debt predicament is that you have a disconnect between the party who paid the tax, i.e. the retailer, and the party who wrote off the bad debt for federal income tax purposes, which would be the lender. So what you have is a requirement in filing that claim that you provide assignments of rights generally between the two parties. And the requirements, I would say, are less in the private label space and greater in kind of the general purpose credit card space. So be mindful of the fact that there's additional procedures that have to take place surrounding bad debts. Additionally, successors. So if you're acquiring a company, pre-acquisition period, who has the rights to those refunds? Is that you as the acquiring entity? Do you obtain that as the succeeding entity? Or is that something that contractually or statutorily is held within the original entity? And then finally, class actions. And I think across the U.S., most states have generally frowned upon class actions within the sales tax space, basically saying that you have other avenues that you should be pursuing first, and if you haven't exhausted them, you can't just class up and go file a lawsuit. But that's not the case across the board, and it's something to be mindful of in terms of refund claims and certifying a class, et cetera. So additional procedural requirements within those types of claims. I don't love to read slides. In fact, I kind of hate it, and I hate it when people do it to me. But that said, I think this is one of those slides it's going to really sound like I'm reading. A number of basic requirements that exist within refund claims. First, it has to be in writing. You have to specify the grounds for the claim. You have to tell the state what the amount is you want back, and you have to tell them what periods you're looking to change your original filings for. That, in addition to those requirements, you have a lot of different state-specific items that come up, whether it be state-specific claim forms, schedules of transactions, potentially amended returns, et cetera. Within the sales tax space, one thing that, to my knowledge, every state you're going to have to provide is a schedule of the transactions that you're looking to obtain refunds for. And this is just a quick example. You can refer back to this at your leisure or not, your call. But basically, you have to put a couple of things in here. First, you want to see it on a transactional basis. States are going to want to see on a transactional basis what the refunds are for. They're going to want to have a narrative explanation of the transactions where you're requesting a refund or why you're requesting a refund, i.e., why didn't you think you should have paid tax on this originally? As we think through just some other specific issues around the filing of refund claims, sales tax versus use tax, I think the big issue here is to just consider whose return is being changed or amended as part of this. This really kind of is most relevant within the purchaser claim side. If I'm a purchaser and I am filing a refund claim that is for sales tax, that is tax that somebody else put on their return, so I can't really amend another party's return. But if I'm amending my own use tax that I self-assessed on those purchases, well, then it's my own return that I'm going to amend, and as a result, that's generally going to be a requirement within the refund process. Bad debts we spoke about earlier. There's a litany of other requirements that come up in this space. Apportion purchases, and specifically thinking about like software claims or direct mail claims where you're saying, look, I didn't use all of this stuff in this one state. I used it across the country, and I want to apportion the use across the country in accordance with where it was actually used, and therefore I'm entitled to a refund in the state where all of the tax was paid. In order to support that claim, generally speaking, you're going to have to provide some type of documentation as to how you've apportioned those purchases across the country to support the refund claim. The next is this incentive programs and certifications. Minnesota, the clearest example here is around data center issues. Minnesota has an exemption for qualified data centers, but as part of that, you're going to get a certification from the Department of Employment and Economic Development, and you're going to have to include that certification within the filing of a refund claim. So Minnesota is not alone in this. The vast majority of states have different incentive programs or certifications, many of which apply to sales tax. So North Dakota has a primary sector certification. Kansas has an HPIP. Georgia has the high-tech exemption. Nebraska has their advantage. And they're all different. There's all different certifications. But generally speaking, if you're filing a claim that's based on that certification, you're going to need to include that certification within the refund claim itself. And then the last kind of three buckets here really apply to income tax refund claims. And generally speaking, when it comes to income tax filings, you're going to have to provide an amended return, and you're going to have to provide grounds or an explanation for why you've amended that return, as well as any kind of supporting schedules or forms that go into that general return. So just some other requirements there. And I will turn it over to Masha to talk about timing.
The timing of a refund claim is really important, and even the standard statutes of limitations will vary by state. And in Minnesota, for example, the statute of limitations is either 3.5 years from when a return is due or 1 year from the date of an order assessing tax at an audit or an administrative appeal. And then in that latter context, the 1 year, the refund claim has to be within that amount. What's important and really different about Minnesota is that you can't file a refund claim from the date that you paid the tax. And so that's really different from the majority of states and also from the IRS. For those of you who practice in the federal space, there it's 2 years or 1 year or some period of time after you paid a tax that you can file a refund claim. Minnesota doesn't have that type of statute of limitations for filing a refund claim. And that can be a real trap for people who are engaging in either a multi-state practice or typically do federal practice and now want to file a refund claim in Minnesota. So again, the key here is it really differs from state to state, and it's important to preserve your rights and make sure that you know what the statute of limitations is.
Yeah, and I would add, I was just going to add really quickly that the statute of limitations, I mean, most states, you're going to have a similar statute of limitations for assessments and for refunds. And I think that's, generally speaking, is the norm. A kind of shocking development a couple of years ago was one state, Missouri, had actually extended their statute of limitations only for refunds. So that's an anomaly, but it's something to be aware of that on the refund side, Missouri, you can file back 10 years while only being subject to audit over a 3-year period.
Yeah, that's a really good point. And the other thing I didn't mention is that for purchaser refund claims, that statute of limitations runs from the date of the invoice as opposed to from the date of the return. So that's another thing to track, I guess, if that's the area you're going down. Another way that you can file a refund claim or make an offset type argument is during the course of an audit. So if you're in an audit and you have refund claims that you can claim, the question is when should you raise that? In Minnesota, an auditor must allow the refund, even without a demand by a taxpayer, if the auditor finds that an overpayment occurred, but it has to be within the statute of limitations for the refund. And so the question is, do you do that? You're engaged in a long audit. Do you raise the issue right in the beginning, in the middle of the audit, at the end of the audit? And a lot of that really depends on the relationship with the auditor. Is this an auditor you know? Is this a new auditor that you're trying to get to know and establish rapport with? And so you really have to read the situation. And then in some states too, there's an interest impact depending on when you raise the issue. In Minnesota, there wouldn't be, but I know that that comes up in some states.
Yeah,
so
I think an
example
just of the interest impact that I've seen is within California, and it's not to do so much with when you raise the issue, but the issue in California is if you obtain a refund claim, generally speaking, you're not going to get interest on that refund. But if you are able to process that refund claim as a credit through your audit, audits do carry an interest impact. So if you can offset something within the audit, there's an interest benefit to doing so.
Yep, that's a really good point. So if you go to the next slide, there are some specific issues that can come up with regard to the timing of a refund claim. So the first issue is, let's say you file a refund claim and it just gets paid. So you didn't have any audit, you didn't have to deal with anyone. It's important to know that that amount that was paid out can be reassessed by the Department of Revenue, either as an erroneous refund or as a refund paid in error. And there are also statute of limitations on the department for issuing those assessments. And so don't count your dollars too quickly when you get the money without having gone through any sort of audit, because the state can definitely assess it back if they still have the ability to do so. And that presents a really awkward situation, as Kyle had mentioned, if you're filing a vendor refund claim and then need to return the refund to your customers. So you have to, let's say in Minnesota, return it within 30 or 60 days, but then the Department of Revenue has 3.5 years to assess it back. And so it can create a really awkward situation. So it's important to follow that through to make sure you know what the deal is with using the money you receive in the refund. As I mentioned, if you're trying to get a refund of assessed items, so if you received an assessment and you want a refund, you need to file that within a year of the order assessing tax. Another issue that we're dealing with is what is the impact of waivers of the statute of limitations? And so if you're in an audit and you sign a waiver to extend the statute of limitations for an assessment, does that also extend the statute of limitations for refund claims? In Minnesota, the answer is yes, if you're signing it with the Commissioner of Revenue. So if you're looking at the waiver, it'll allow both for refund claims and assessments to be asserted after the typical statute of limitations expires. But if you're in the income tax context, and let's say you have a waiver signed at the federal level with the IRS, what is the impact of that on refunds and assessments at the state level? So in Minnesota, the Department of Revenue's position has been that a federal waiver of the statute of limitations only opens up the state statute for purposes of assessment, but not for purposes of a refund. And so that is an ongoing issue that we're trying to work on to fix statutorily, perhaps through the tax section. But it is something to think about anytime you're signing a waiver, especially with a state that wouldn't have that in their statutes. Make sure that it will apply equally to assessments and to refunds. The bad debt in that situation, there's actually a special statute of limitations. It's different from the typical, and that one you can file a refund as an offset on your next tax return, and that's within 3.5 years of the write-off or when the debt becomes uncollectible. And then with closing agreements, let's say you're resolving an audit, and be careful to make sure you know what the impact of that closing agreement is on refund claims relating to either the same issue or a different issue. It may prohibit refund claims from being filed on the same issue, so that's something to make sure you're aware of. And if it doesn't, think about what the impact is of filing a refund claim on the issue that you just resolved in an audit. What's the impact of that on your relationship with the taxing authority?
Yeah, I think the closing agreements, that's something I haven't seen a whole lot of recently, but I would say 7 to 10 years ago, you saw a lot of that where states were pushing closing agreements that would close off periods for refunds at the conclusion of an audit. So something definitely to be mindful of. I hope we don't see much of that coming up. Moving on, so you've at this point kind of talking through, like, you've reached the point in time where you're saying, okay, I have this refund claim and I'm looking to file it. It's significant enough that I think it makes sense. But here's some other issues that you probably want to think through prior to kind of filing the actual claim. First is, what is the audit risk that can come out of that? And, you know, we all recognize that there's some audit risk that comes out of filing a refund claim, and some companies have a policy of, we're just not going to file unless we're under audit, and that's not without reason. I've had clients where we filed refund claims and state auditors got on the phone and said outright, the only reason I'm auditing you is to reduce the refund claim. Now, I personally think that's bordering, if not past the line of being unethical, but that's the situation we were in. I would say that varies based on state, obviously. And another thing that varies based on state is, what does that audit risk really look like? For a state that has vendor claims, if you are a purchaser who wants to have your vendor file a claim, you're obviously not at as large of a risk of triggering an audit if your vendor files a claim as if you as a purchaser file a claim, just based on whose name is going in front of the state. Now, are you without risk? Absolutely not. But that's something to consider, because I think it does change the risk profile. The next impact here we're talking about is public relations. And I think this just gets to the fact that, you know, it's not always just about tax. And filing a tax refund claim in some circumstances could have an impact on your business that is outside of the tax department. So keep in mind what that refund claim, if it hits the headlines, the light that could shed on your organization. And I would say, beyond just the refund claims that are completely valid, you got the tax back you never should have paid, and nobody should have a problem with that, but sometimes they do. Even worse than that we have seen a number of times over the past, my career, where nefarious actors were filing refund claims that were completely illegitimate or unfounded, whether it be that they weren't statutorily supported or that they were just completely fabricated. So be mindful of who you're hiring if you're going through that process to file refund claims, because the last thing you want to do is have your name as a company attached to something that shows you're trying to obtain a refund claim that was not founded in the first place. The impact of attorney-client privilege is an item I wanted to take a little bit of time to discuss, because I think it's gaining some importance now as we kind of move forward. More and more, we're finding states, as items reach the litigation phases of the controversy process, requesting documentation or exchanges that took place within an organization or between an organization and their providers. Now, there's a lot of things that I'm completely fine with showing a tax court or the Attorney General's office, but there's also strategical things that take place as you're communicating within your organization or with your service provider. So the message here is be extremely, extremely careful on what you're putting in emails, because operate under the assumption that unless you're emailing your attorney, in which case attorney-client privilege would apply to that conversation, and it doesn't have to be handed over during discovery, unless that situation exists, that's something that you could potentially have to hand over during the litigation phases of that engagement. So be very careful and mindful of what you're putting into email communications. The taxpayer rights advocates, this is an area, this is a great card to use. Almost every state has people in place that are hired by the state to operate as taxpayer rights advocates. So if you're having issues pushing things through during the review of a refund claim, reach out to the TRA within your specific state, have a conversation with them and see if they can help. It's certainly not going to hurt anything. And then finally, the impact of streamlined agreements. So the streamlined sales and use tax agreement, a number of states have agreed to this. And states are very, especially the policy people within the state, are very mindful of how closely aligned with the streamlined agreement they are, and anything that might be taking place that would put them outside of the streamlined sales and use tax agreement. So while it might not be important to your auditor, for those of you who were on our session a couple weeks ago, the people on that session, the policy people at the head of the state, are going to care greatly if auditors are doing something that puts them out of alignment with streamline. With that, I'll turn to Masha.
Yep. So we talked about Minnesota's optional deemed denial of a refund claim, and this is another consideration to keep in mind when you file refund claims. So in Minnesota, as I mentioned, what it means to have an optional deemed denial is that after 6 months, if there's no action on your refund claim, you have the right to move it forward. It's taxpayer's choice. In some other states, it's a mandatory deemed denial. And so what that means is your refund claim, if there's no action on it, is deemed denied after a certain period of time. And if that date is not calendared and you don't file an appeal or begin asserting your procedural rights, you lose your right to a refund altogether. And so it's really, really important to know which states have those mandatory deemed denials, and if you're filing refund claims in those states, to make sure to docket or calendar the deadline for when that deemed denial occurs, because it could trigger the procedural rights that you would have and lose if you don't exercise. Second, the risk of reassessment by the department, I think we've already covered sufficiently. You get paid the refund, Department of Revenue can take it back. So you have to make sure you're accounting for that. And then Kyle, do you want to talk about alternative options?
Yeah, so I think, you know, we've talked a lot about just filing refund claims in the standard manner, but I would just add that depending on the situation, some taxpayers do take advantage of other ways in which they can obtain refunds for items. Prospective credits, the place I've seen this most often is within the bad debt space, where you have debts that are constantly being charged off and then taken credit for on a future period return. So that's an option. Is it the technically correct answer on a state-by-state basis? Probably not, but that's something that some taxpayers do take advantage of. Short paying invoices is certainly another, where you have a vendor that's charging you tax and you look at it and you say, look, this is not a taxable transaction. I shouldn't be paying tax on this. Short paying that invoice is certainly within your rights, and, work through that issue with your vendor, obviously. but that's something that a lot of companies will do. And then just leveraging a positive result here. So as you go through the refund claim process and obtain a positive result, some just different things to consider. Depending on the state, there are abilities to obtain advisory opinions or letter rulings on specific positions. Now, having a refund claim that was issued to you is certainly something that you can point to if later you would be assessed on the same issue. But having an advisory opinion or a letter ruling from the department, and that's going to carry greater weight in terms of documenting exactly why you didn't pay tax on those future transactions, and then having a good position to take with the department. I would also add that settlements, that's an item that if you're settling something, say within an appeal proceeding or whatnot, and it's not going to be issue specific, in terms of weight of something that you can rely on in the future, probably the least weight you can rely on is hey, we settled on this issue in the past. Masha, I don't know if you had anything to add to that.
No, I think that covers it.
All right, we will go on to our next polling question.
So the polling question is, how many state tax audits do you or your team typically handle in a given year? 0, 1 to 5, 6 to 10, 10 to 25, or 25 plus? I'll give you about 20 seconds to answer. Wow, I'm surprised at how many don't handle any state tax audits. That's an interesting number, but most people, it looks like, have about 1 to 5 per year. Right? That's fantastic. All right, so with that, we'll transition to audit examination. So sort of switching gears a little bit. So typically, the first indication that a state agency is auditing you is the receipt of any one of these letters or notices. Sometimes it's a nexus questionnaire. Sometimes it's a letter that says, hey, where's your return? You should be filing returns here. Sometimes it's just an audit notice saying, hey, we're auditing you, give us some information. Or you might not hear about it until there's a notice of proposed liability or a final order or something called a personal liability notice. And so what we wanted to do was sort these into panic or don't panic categories, but instead what we're going to do is do a lightning round of Q&A called panic or don't panic. So, all right, Kyle, first one, nexus questionnaire. Do you panic or not panic if you get one?
I'm gonna give the super cagey answer to most of these. Nexus questionnaire, if you're not prepared for it and you haven't evaluated the kind of nexus on an entity by entity basis, maybe panic. If you have, I would say, trust the results that you've concluded and stick with that and don't panic and move forward.
All right, how about requirement to file? Panic or don't panic?
I generally don't think that's a big deal. I wouldn't worry about it.
What about an audit notice? Hey, you're being audited.
Audit
hey,
notice is,
you're being audited.
Yeah, I think that's kind of the same boat as the nexus questionnaire. If you've put in place processes, and we'll get into this in a little bit, that to mitigate risk when that audit comes up, so you have documentation in place and you feel good about that documentation, then it's not a moment to panic. It's certainly not a happy moment, but it's a whole lot better if you've done that than if you have not.
All right, let's skip to the notice of liability, final order. If you get that and that's your first indication of an audit, panic or don't panic?
Is it a zero change? Because I think that's when you let dance in the street. But if you have a large amount on a notice of liability, it really depends on how that audit has progressed. Do you feel like the items within that liability are real or not? Because there are different avenues to pursue to appeal an audit, and sometimes you just get the short straw when you draw an auditor.
I would also say, depending on how old it is, if you get an order on your desk that's several years old and this was the first time you're hearing about it, I would panic. How about personal liability notice?
I think the worst possible thing to receive would be a notice of personal liability yourself. I mean, you've probably done all right for yourself if you're getting personal liability notices, but nobody wants to get that. I would say a close second is when, you know, your boss's boss's boss in the C-suite or as an officer of the company comes in with a notice of personal liability and puts it on your desk, and you know it's legitimate. So that's a panic moment.
And for those of you who don't practice in this space, personal liability notices come into place when there's a tax assessment that hasn't been paid by the company, and a personal liability notice is issued to individuals responsible for that tax. And what that means is that the department or the agency can look through the company to your personal assets to satisfy the company's liability. That's why they're really scary. All right, so this slide just talks about kind of some things that come along during the course of an examination, like document requests, information requests, waivers. So let's go to the next slide because this one's not that interesting. All right, so this lists some of the items that may be requested depending on tax type, the state, the auditor, et cetera. And it's a pretty long list. So, you know, usually with an audit, the first thing you get is a request for a whole bunch of documents. And so on this one, Kyle, let's do a little Q&A. Which of these would you say is the easiest to comply with?
I would say depending on your data, but you know what? Tax returns. Tax returns is the easiest, right? Everybody has a copy of those. That's the easiest.
All right. And which request would you say is the most ridiculous in your view?
Tax returns, because the state already has them, so they should be able to look them up themselves.
And which one is the most reasonable, let's say in the sales and use tax area?
So accruals, generally speaking, you know, again, depending on how clean your data is, would be accruals, work papers, you know, documentation, again, depending on how clean things are within your organization. But those are generally reasonable in supporting a sales tax audit.
And which of these items would you typically push back on?
So the general ledger items, some states will come in and want to see a complete general ledger, all states. And I think that's like ridiculous and not something they should be entitled to because it doesn't relate to the activity within their taxing domain. So I would push back on a complete GL if they ask for that. And then these kind of last few items around like system config and design, taxability matrices, things like that. I've seen in certain circumstances people ask for that, and I think that that's completely outside of the state's ability to access. They shouldn't be entitled to get that information. It doesn't have to do with the actual taxability of the transaction taking place or the result. They can get all of the answers they'd get there somewhere else, and they should be looking somewhere else. And I would say bank records, I haven't run into that as much in my practice, but yeah, that would be something that would offend me and I would push back on.
Mm-hmm. All right, so let's go to the next slide.
All right, so our next slide talks about, you know, objecting to those items. And I think, you know, just kind of to summarize what we're looking at here, there's a few different concepts. I think the first concept is don't overshare unless it's helpful to your case. If a state asks for one thing, don't give them another because you presume they're looking for it. Give them what they asked for, but only after making sure that it in fact is clean. The second is it is okay to say no. States come in oftentimes with huge and broad information requests. It is okay to say, no, that's not something that you should be able to have access to, and I'm not going to give it to you. Get it some other way. So kind of have that in the back of your head is that it's okay to say no. And then third is that auditors don't have to be adversaries. I think having the better relationship that you have with your auditor, generally speaking, the better your audit is going to go. So work hard to preserve those relationships, even if you are, you know, taking a position that there's certain information that they're not entitled to. And then finally, I think that at some point, this I've got this mentality may not be true anymore. So look for help. And that doesn't necessarily mean look for help outside the organization. It may, but it also may mean reach out to people within the organization to see if they can help you. It might be if you're a sales tax person and you're looking for information, go talk to your income tax brethren or talk to people within IT. See what you can get within your organization that could be helpful in addressing the problem that you've stumbled upon.
All right, so here we just list some typical issues that we've been seeing on audits. We have been seeing a lot of nexus audits, especially in the Public Law 86-272 space. For those of you unfamiliar with Public Law 86-272, that is a federal law that prevents states from imposing income taxes on out-of-state taxpayers in certain circumstances. So because it's a federal law enacted by Congress, it wasn't affected by Wayfair. And so, but the states are nonetheless sort of trying to chip away at Public Law 86-272 and the protections that it offers. And so we've seen a really, really big uptick in those. There's always audits about missing supporting documentation, especially when it relates to credits, deductions. We're seeing that in the R&D space, pretty significant challenges to research and development positions, requests for supporting documentation that are very unusual compared to what we've seen in the past, so sort of anything that gives the taxpayer a benefit. Obviously, positions that are taken on returns in the income tax space, that would be any unitary or forced combination type issues. So if you're taking a position on a return that you're not unitary with another entity that's within the group, somehow related to the group, those are being challenged quite aggressively, as well as positions on whether the sale of an asset or a business constitutes business income or non-business income, another really common issue. And then industry-specific audits. So right now we're seeing a lot in the healthcare space, healthcare industry, especially as it relates to worker classification. So whether a worker is an employee or an independent contractor is really prevalent right now, especially in that healthcare space as it relates to doctors, nurses, and other healthcare workers. And there's other industry-specific audits that come and go that we've seen sort of over the course of time, but that's the one I'm seeing especially right now.
Yeah, and the next slide here just talks about atypical tax impositions. I think the point here is that states tax weird stuff. And if a state taxes something strange or atypical, that's generally going to be an area of focus for them. I would also call attention to the Wisconsin telecom, because Wisconsin seems to think that software is telecom. And I don't know what more to say about that, but that's an area to be concerned about. In terms of defense strategies, this is where we're going next here. The first area we really wanted to talk about is just preparation. So I think almost everyone here has been involved in or present at some type of demo around different types of technology. There's a lot of technology out there that allows you to create reliable and accurate data sets that reconcile and are consistent on a monthly basis, that take advantage of that type of technology if at all possible. Utilize dashboards to identify problems and then help correct them in close to real time. There's providers out that provide exemption certificate management software or tax engines that help with rates and determinations, things of that sort. Utilize that technology because although it's not going to get you to a place of perfection, generally speaking, it's going to get you a heck of a lot closer and going to make your audits a lot less painful when you can get to your original contemporaneous data on a very quick basis. The more time you spend on audit, the more resources and generally money that you're wasting. Next is just store relevant documentation. So, statute of limitations for sales tax or income tax generally are going to be 3 to 4 years on a state-by-state basis. So, keep in mind your statute of limitations before you set a policy of this sort. But generally speaking, keep a minimum of 4 years of data, invoices, exemption certificates, et cetera. Any apportionment schedules that you have for things like software that you're apportioning out or direct mail, things that you're going to need to be able to provide to the department to defend an audit or to potentially defend a refund claim. And then
can I add something to that, risk. Kyle?
Yeah.
Yeah, so to the storing relevant documentation, that becomes especially important if you have any anticipation that you're going to be litigating the issue. So if you know you're taking a controversial position on a return, if you don't have the documentation that supports that position when it comes time to litigate, there are penalties for not having kept that documentation, including an adverse inference, meaning that it said something that was really, really bad for your position, as well as monetary penalties. And so anytime you're taking an aggressive position, you should decide whether there is what we call a reasonable anticipation of litigation at that stage, or if that comes later. And if there is, then you have to do a litigation hold to preserve all those relevant documents.
Thanks. So the other space is just around taking the time and effort to mitigate risks. We talked earlier when Masha was talking through, some of these different department notices or forms that show up at your desk. And the Nexus questionnaire was one that I kind of paused with, because if you haven't taken the time to do an entity level Nexus evaluation, and it's in any way relevant to your organization, take the time to do it, because the last thing you want is a department showing up and saying, I want to look at your org chart and figure out where you could potentially have Nexus within the state. That the goalposts have moved so much within the last couple of years that this is an area that I think represents significant risk to a number of organizations. And then kind of compounding on that, voluntary disclosure agreements, private public letter rulings, these are opportunities for you to help mitigate risk when you become aware of it. And finally, financial statement reserves. If you don't want to come forward to the state and disclose that you have, or you're not in a position to disclose to the state, you may already be filing, et cetera. Putting up a financial statement reserve so you don't, end up in the position where you have to tell your boss that you have a large assessment for an issue that came completely out of the blue. So I think a lot of this, as we've talked through defense strategies, is kind of what you can do in advance. But at the point that you're actually engaging with state taxing authorities, know your state. Know the people within that organization. If you know your auditor, great. Otherwise, if you know people with higher up within the organization, that's going to be helpful. Know the policies, and if you don't, reach out to somebody who may know better than you, because the point at which you have that conversation and know in advance of what the state's general policies are surrounding information request items or things of that nature, you're going to be in a much better situation. In terms of audits, one of the things that I get fairly riled up about is sampling. And this is just because I think a lot of times people just blindly agree to sampling. And the samples don't really represent, the sample results don't really represent what an actual liability would look like. So I think being diligent prior to agreeing to a sampling methodology is really important. And if you don't agree to it then, it's too late. Once you've agreed to a sampling methodology, generally speaking, it's going to be too late to do anything about the impact of that down the road. So work through the sample. There's a couple tips here of things to potentially eliminate or want to be sampled in a different sample stratum, et cetera. And you can review those at your own leisure. In terms of missing documentation, which is an item that comes up quite a bit, exemption certificates are one item that is generally one of the first stops an auditor makes when reviewing transactions. If you don't have exemption certificates, reach out to your vendors, take a top-down approach, try to get them where you can. XYZ letters, this, for those that aren't familiar, just because you didn't pay the tax doesn't mean the other party to a transaction didn't pay the tax. So one thing that you can avail yourself of is reaching out to, if it's a purchase transaction, your vendor, if it's a sales transaction, your customer, and seeing if it's something that they self-assessed or have been audited and assessed on that transaction, because only one party should be paying the tax on a transaction. And then finally, just because the traditional documentation is not available doesn't mean that alternative documentation isn't. So, you make a purchase from a vendor, you can't provide the invoice and audit, and you're going to get assessed. Reach out to your vendor and see if they have a copy of the invoice, or see if there's a purchase order. Work again. This is why not being adversarial to your audit staff is helpful, because you can work through other ways in which you can document transactions. In terms of taxability disputes, I think again, just a few overarching trends here. First, be nice and professional. Work through the department's chain of command. Just because you don't agree with the auditor on something doesn't mean that you can't sit down, have a reasonable conversation, maybe invoke their supervisor, lead worker, or even go up to the head of the tax division. Work through the chain of command if necessary, but be respectful of those people, because the more adversarial you are, the more difficult that conversation gets. I would say be thoughtful about what you're saying and what you're providing. Review everything before you provide it to make sure it says what you think it says and nothing more. And don't answer questions that you haven't been asked. And then, know your statutes, the regulations, know how they actually apply and what weight they carry within your taxing jurisdiction. And then keep litigation in mind early, because if you're planning for things to be litigated, if you're planning for controversial issues to be litigated from day one, it's going to be a heck of a lot easier to deal with once you're actually in the heat of having to litigate that issue. And with that, we will move to our fourth polling question. How comfortable are you in your organization's preparedness for audit? We'll give you a few seconds and close the poll. Okay. All right, and let's see what our results say here. Not unexpectedly, it looks like the people that are showing up and want to find out more about this stuff are the people that are generally on top of the issues. But again, perfection, especially within the state tax space and the variability state to state, is often difficult to achieve.
All right, so we're going to zoom through some of these appeal slides. So I think the first question that usually comes up is, do you even want to appeal, or is it better to resolve the issue? And sometimes you can get a good resolution at audit. Sometimes it takes an administrative appeal. Sometimes it takes filing, initiating litigation in order to achieve a settlement. And there's a lot of considerations, and you can peruse these at your leisure. But I think the most important thing is that it's not just about sort of a cost benefit on the dollar side. There are a lot of other angles and thoughts that you should consider before moving forward with litigation, including sort of publicity, including what are competitors doing, what's the impact on other states, et cetera.
Okay, so on the administrative appeals front, I think the primary message, and you've been hearing this throughout today's session, is that states are different. And one specific thing that I want to call out here is that when it comes to appeals prior to litigation, some states like Minnesota will allow you to move forward through the administrative appeals process with a representative that is not a licensed practicing attorney who's admitted in that state. However, that's not the case in all states. So if you go to Pennsylvania, you go to Missouri, if you have a representative in those states at the administrative appeals level, because that's considered a tax tribunal or it's in front of an ALJ, the representative must be a practicing attorney admitted in that particular state. Other things that vary by state, appeal timelines obviously differ, whether extensions are accessible, in-person hearings, supplemental documentation, et cetera. On our next slide here, which is really discussing the appeal kind of process, one thing I really want to call out here is that appeals reviews the audit file, which means that appeals reviews the file provided by the audit division. So a big question, and something that you'll hear different answers based on which appeals officer you're talking to, is whether appeals can raise new issues or positions as part of that process. I would say no, but that's something that we've definitely struggled with dealing with different appeals divisions about. But I think at the end of the day, appeals is not the audit division, and they shouldn't be auditing clients. Similarly, if you haven't provided an issue prior to appeal, to bring that up within appeals, you may be cut off because it may be viewed as too late by that appellate officer. The other piece here is just preparation for litigation. I mentioned before to prepare early if you have truly controversial issues. making sure that you're creating a trial-ready file as early as you can. And you know, if you're preparing throughout the audit, throughout the appeals division kind of proceedings for that possibility, you're going to eliminate duplicating efforts and costs at the point that you do end up litigating those matters.
All right, and the last two slides really deal with litigation and when you choose one versus the other. So sometimes we skip administrative appeals. They are optional, and there's lots of reasons why we may or may not do that that I'd be happy to discuss with you offline. But in the interest of time, let's go to the next slide. We also in the beginning mentioned the difference between district court versus tax court and how you make that decision. So you can use this slide for reference, but the key difference is pay to play. Usually you have to pay to go to district court versus tax court you don't, the tax assessment. And then second is you have a generalist judge in district court who may or may not know anything about tax versus tax court you would have a specialist. And then the last slide lists different ideas and different thoughts about various litigation strategies. And I could probably talk for a whole hour about all of these. And so maybe we'll save this for a full separate session. And I think the most important thing is know when you're creating your record. And if you're creating your record at a tax tribunal or an ALJ level, you need to have someone there who understands rules of evidence, who understands what a record is, who understands the rules of civil procedure. And then the last slide kind of echoes that, which is by the time you get to a Supreme Court or appellate level litigation, you have to have a really good record below, and that all the issues have to be preserved. So with that, we hit our last polling question. Which section had a hidden photo of Kyle, where's Kyle, lurking in the presentation footer? And it did not have his mustache in it, or moustache. All right, so let's close that poll just in the interest of time. See, Kyle, a mustache. Should have picked a different picture. It was in the refund claim section. It was on the second slide in that section, I believe, in the footer. All right, well, Fantastic. With that, we will conclude our webinar. We hope you can join us next week for the fourth one in this series. And then as Kyle said, hopefully in the future as well, once we switch to monthly webinars. If you have any questions or thoughts or want to hear about any of these topics in more detail, feel free to reach out to either Kyle or myself, and we'd be happy to help with that.